segunda palestra do Claude Serfati sobre regulação bancária na Europa, na União Europeia. Eu gostaria de agradecer novamente. I would like to thank you again for the lectures, Professor. And the stage is yours. Thank you.
Okay. Bom dia a todas e a todos. Desculpe-me para não falando português. So I will address in English on the political economy of the European Union, and in particular more focused on the regulation or the attempt to regulate the European banking system. The arrow does not work. The arrow does not work. Okay. I can't go down the... Yes, okay. I wrongly thought that I would have something like 8 hours from early morning this morning to late evening to address this story, so I prepared a very long presentation. But so you can see and you can get my PowerPoint, which is freely available with, of course, due reference to the source, but you can use whatever you want. So rather than boring you with a 8 hours presentation, I just begin to summarize the main point regarding the background in which the EU banking system and regulation are addressed. So there are very short points I will not develop in the first part of my presentation, but of course I can discuss if there is any problem, and even if you want to interrupt me just to get some information, do not hesitate. I really like interactive discussion. So the first point, of course, is not to forget that the EU banks, and not only the banks, but the EU economy as a whole, were and are at the core of the epicenter, if you want, of the financial crisis which began in 2007. Of course, the crisis started from the US economy with a subprime, but you have to take into account a very important point, in my view, that is the interrelation between the strong partnership between the US and the EU capitalism. It's what I call, from a geo-economic perspective, the transatlantic bloc. 2, the EU banks as a whole are very competitive on the world market, on the world scale. And you can see just very briefly, but you have more detail in other slides, I will not comment on, that the EU system, banking system is very strong on the world level with a pole position in global trade in financial service, with 25% of financial service exports worldwide. And you can see that if you compare the population of the European Union, which accounts only for 7% of the world population, you can compare this kind of statistic with the GDP, roughly 1/4 of the world GDP, and in banks relative matters, you can see that the EU banks are very strong, accounting, for instance, on the very important over-the-counter derivatives, for 62% of the world market. I have to say it's very important that it is mainly the London City of financial services which is leading in this kind of business. But even the continental banks as such are strong. 3, main point, very briefly reminded to you in my presentation, is that the EU economy remains dominated in most countries by a bank rather than by a market-based system. You can just, again, you can read more easily and relax after, but you can see that the figures illustrating that the EU economy is a bank, mainly bank-dominated system, and see the significant differences with the EU system, the US system, sorry. You have, another point important is that you have within EU different business models, so to speak, in the banking system with a rather Anglo-Saxon, US-inspired, if you want, mainly in the UK, and a continental model. I will come back on this point about regulation because the German model is quite interesting from this perspective. If I jump on the next main point of the background, I mean if I address very briefly the industrial economics of the banks industry, you can see that, we can observe that the EU system is made up of a very small oligopoly of large banks, universal banks, which are dominated by a very few countries, namely the UK, France, and Germany. Another point relevant to industrial economics of the bank industry in Europe is that, no, I won't not, is the rise in internationalization of large banks before 2007. But quite important also to understand the background of the regulation, the main part of internationalization took place in Eastern Europe. I mean, it was not really a global, it is spoken of a global extension of the EU banks, but mainly the EU banks remain buttressed on their domestic market, and from there went hunting, so to speak, a bank in Eastern Europe just after the collapse of USSR. This kind of business model, continental mainly business model, I mean this kind of move only and mainly towards Eastern Europe, is that the EU banking system has created strong interdependencies among each other and with each other in the EU. I address and I just explain this point in another further slides I will not comment on, but which is in my PowerPoint. Through many links, you can see strong interdependencies between European banks and within banks in each major country, namely the UK, France, and Germany. And another point, very important, I just jump over very quickly, is that just to address the crisis, the EU banking judged to be too big to fail, or now in a more theoretical parlance, systematically important financial institution, because too big to fail is just a little bit pejorative, received, the too big to fail banks received large subsidies from their national government. Very important, I stress on their national government. Even the fundings went through European channels, it was mainly a national-centered support to national banks. You can see just the sizable amount of money spent by European government, over 40% of their GDP. And one of the last point, and I just came to my to the core of my presentation now, is that so far, I mean at the beginning of the first trimester of 2014, the real restructuring of the EU banking system has been so far very, very, very limited. Let me jump to the 19th slide. Okay, I think it's roughly okay. I just mentioned this point. Finally, to just set the scene, if you want, just paint the general background, I would say that, drawing on what I said on the massive domestic support, you have a very, very return to a home base, which is rather a paradox, while it is very, very loudly spoken about the achievement of the banking union. Of course, I will come again in a moment. And I would just stress by passing that in my view, this kind of return to the home base, of course, there are banks like other transnational corporations are very global in their strategy. But the role of the domestic market remains quite essential. And of course, for me, it's kind of confirmation of what I just wrote on the role of state, national market, and so on in the so-called globalization. So you can see, for instance, regarding other banks, not transnational corporations in general, but banks, how the return to the home base went through, was managed through banks considered as national fortress. I mean, they go on playing a decisive role in domestic economy, namely, and to begin with, in buying up treasury bonds. Of course, you know that the public debt is the engine and the fuel, both engine and fuel of financial market, and the bulk of the public debt in Europe is held by European banks. And more precisely, the public debt in France is mainly held by French banks. The public debt in Germany is mainly held by German banks, and so on. And another channel confirming the connection between the home base and the so-called global bank is the pressure that the national government exerted for banks financing domestic projects after 2007. Of course, I address this point. I mean, even when they received money, they were hardly pressed to finance not foreign or overseas or abroad projects, but domestic projects. Of course, the regulatory framework goes on being a very national center, even if I will discuss this point, the EU banking regulation is aimed at leveling the playing field, but so far the regulatory framework remains very national based. State aids, I mentioned, even if they went through the European community, if you want, community level, return back to national bank. I mean, if the French government funded for 100 to the community program to support bank, 100 came back in France to support French banks. So it was a kind of just circular process. And the last point was, at that time, at least, I mean, until 2012, the weakness of the EU-level reaction to the crisis regarding the bank and more generally the crisis. So let me now address the bulk of my presentation, the regulation of the banking system, which as dare to write is a long way off. To begin with, you can see that there has been great expectation and discourse on the need to regulate banks, considered in Europe as the main culprit of the crisis, the main responsible of the crisis. They were very harshly criticized even by government keen to be in compliance with what the public opinion was saying, that the banks were responsible for the crisis, which is a plain evident. Even President Sarkozy in France declared, as he used to do with very, very emphatic claims and somewhat ridiculous claims, that now the G8 and Europe has waged a financial war with the financial market and so on and so forth. But when we come back and come down to earth, not in discourse but to earth, when we landed down to earth, we can see that there has been very, very modest implementation of policy aimed at reining in banks. I will not address, for instance, but I just mentioned in passing, the so-called tax on financial transactions, which was quite considered as an evidence, as realized in Europe just in the last months. And you can see for a couple of months only, for let's say the mid-2013, that the ECB, as the European Central Bank, has declared, really amazing, has declared that the bank, the European Central Bank, is in principle, I quote, in principle favorable to tax on financial transactions, but we have to be cautious of the destabilizing of the financial market. That is, it's not the actors on the financial market which destabilized the financial markets, as it is, in my view, in evidence. No, it's the threat of a tax on financial transactions which could destabilize financial markets. So I just mentioned this point because it was probably the more advanced in Europe, the more progressive, if you want, progressist point on the European agenda. 13 countries had been favorable, including France, to implementing a tax on financial transactions. It was considered as settled in Europe. And 4 months, increasingly and very, very under the table, the bank lobby and the financial markets lobby began to regain some strength. The crisis, the economic crisis worsening, of course, the capital is in better position to bargain. So the main objective of the structural reforms are as follows. As it was said by a very influential report, I will comment on it. Laikanen, the Finnish representative, was a former high commissioner and published a report on the bank regulation. I will come back in a moment. The objective is to establish a safe, stable, and efficient banking system serving the needs of citizens, the EU economy, and the internal markets. So, just to summarize, the thrust of the Laikanen report is: 1, banks have to finance the real economy. 2, we have to take measures aimed at reducing systemic risk, and in particular its cost for the taxpayers. And 3, the crisis should be a moment for the reinforcing of European institutions as such. You have always to have in mind when I am speaking of the European institution, of European community, I am not just addressing the addition of national countries. Of course, the EU project is a community project, and you have to distinguish it from the addition of domestic or national countries. Among this objective, for the reason of this presentation, I will address mainly the separation of activities within bank, which is a very hot topic, as you know, everywhere in at least industrialized countries. And let me just remind you that the universal banks, as they are called, I mean banks practicing investment, loan to household, merchant banks, that is raising funds for venture capital, startup, and so on and so forth. The universal banks were fallen apart with a very famous, I suppose you know, of course, the Glass-Steagall Act voted in the mid-30s under the Roosevelt administration. You know probably also that this kind of regulation refraining banks, separating their investment and their retail loan and deposit taking activities were progressively cancelled at the happy years of globalization in the 90s. It was a very strong battle, for instance, in the US. The Bush administration had to come back a lot of time before the Congress to, at the end of the day, impose the abolition of the Glass-Steagall Act, but at the end of the day, Bush won the battle. It was the same case in Europe, in France, for instance, which is always considered as very backward as financial matters are concerned, was very early, very active in the early 60s, precisely 66, by authorizing this kind of fusion, of merger between investment bank and retail bank. So it is the background of the situation during the crisis and up to now. And the objective, of course, is to reverse to some extent the gigantic size acquired by the universal bank, as they are called, and to put an end to the systemic risk and too big to fail or systematically important financial institution due to the large size, the complexity and the interconnectedness of the banking system. The stated objective, it was explicitly mentioned in the Liikanen report, is to have a less governmental and more shareholder involvement in case of distress or default of some banks. And of course, the objective is to reduce the systemic risk by diminishing the risk of bank failures. Another significant objective was to separate, it was the word used in the Liikanen report, the socially useful activities of a bank, I mean mainly deposit taking, loan to household and to small and medium enterprise, from separating from risky and speculative proprietary trading activities, with the objective, of course, by this kind of separation, to have the risk of speculation, so to speak, transferred from the taxpayers to the creditors, and to, as aptly said by a very clever man, Andrew Aldan. I advise you to read Andrew Aldan. He is a very top high-ranking member of the Bank of England, and who is one of the most staunchest adversary, foe, if you want, of the banking system. He not only is very clever, but of course, he knows the business, and he criticizes the banking system. He has a lot of speech on the public website of the Bank of England, even if you just tape Haldane on a engine search, you will find. And among his very, very clever and focused sentence, he explains that the objective of such law, of such regulation, is to avoid contamination. And even the Bank of International Settlement, which is rather an orthodox and present an orthodox view, at the end of the day, I mean, quite recently, only in 2012, but began in one of his working paper written by the two men I mentioned, began to explain that the size of the bank has become so big that it has become counterproductive. And they even dare to assess from which threshold the bank is too big. They estimate roughly that when the bank turnover accounts for between 90 and 110% of the GDP, it is a threshold from which we have to be very, very cautious and worried with the size of the bank. Of course, we can discuss this kind of pseudo-scientific measure, but it is interesting anyway to observe that even the BIS just gave a little push in the direction of some kind of separation between investment and retail banks. So what proposed more precisely the Liikanen report, the so-called high-level expert group, of course it was to separate retail banks taking deposit from proprietary and higher risk trading with the placement, so to speak, the location of the latter, I mean the proprietary bank in a separate legal entity when the turnover of this kind of speculative bank, proprietary trading bank, exceed 25% or alternatively 100 billion euro or in the bank. So the objective, I do not repeat, is to reduce the cost for the taxpayers and reduce the systemic risk. Still very important because it's a serious qualification of the Liikanen report. Otherwise, hailed as a very audacious report, but a very, very, very strong limitation, qualification to this report is that the model of the universal bank is not forbidden. I mean, you have to separate both activities, as I mentioned before, but they can remain under the umbrella of the same, so to speak, or like Mensky said, the same holding bank company. So, of course, it's very important because it was a point on which probably they would have to fight against bank because the model of the European bank is the universal bank for decades and decades and sometimes centuries like in Germany. So the fact that the Liikanen report maintain the universal bank has been seen, rightly in my view, as a back down from the expert group before the lobby of the European banking. Of course, the problem of separation, I just will address concrete and more theoretical discussion on that point. Of course, it's very sympathetic and nice to propose a separation of retail and investment, but you have to go back to the 30s, and of course, since the 30s, many flaws went in the river, as the French saying used to say. I mean, you never bath in the same bath as said Heraclitus, the famous Greek philosopher. So how could you and how it is possible to separate such activities in a global world, in a integrated at the world scale, financial market, and so on and so forth? So how to separate useful and speculative activities? For instance, to begin with, are market-making activities. Market-making can be defined as acting as intermediary for household, company, or government. Is useful or not? It was a very touchy point in the discussion in the US. It is also a touchy point in Europe. I mean, the investment banks are very keen to explain that when they are playing so many billions of euro, of course, of illusory, so to speak, or fictitious euro on derivative markets, it's not for speculation. It's only for the market to clear, to be a balance, if you want. And it's called market making. We perfectly know that the big five, because only big five American banks control 90% of the derivative market, or as published by a Bank of International Settlement at the world level, I think, I'm not sure exactly of the number, but around 50 global banks account for 90% of the global turnover on the derivative market. You can think that the 15 club of global banks are not only being simply intermediary between people like companies or household or government and other players on the derivative market. Of course, they are very active and not only market making as it is sold. So it's difficult, as you can see here. I don't develop this because I just explained that. You can see in these two remarks that it's very difficult to imagine that you could have a kind of simply bank representing the invisible hand of the market. You need to make the hand visible, so you need a bank, but they are just playing a role of intermediary. Probably, of course, we can document that. I have documented that in other paper. You can see that investment banks are gaining huge profits of their derivative activities. So you have different response given to this first issue, how to separate useful and speculative activities. You have not a unified response. And I just, maybe I can be more brief on this issue. You can see that there are three types of proposals. The so-called Volcker in the US proposals is considered as more modest. The Vickers, Lord Vickers, proposed for the regulation of the UK banking is considered as the most daring, and between them the Liikanen report. So I do not develop maybe this point. I can come back in the discussion if you want. So if I just take up the issue of how separating useful and speculative activities from a theoretical perspective, and not only from a practical or institutional perspective, you have to know, of course, you are perfectly knowledgeable of that ever since the thriving of capitalism, banks have been performing both the provision of means of payment and credit in an entangled way. I hope to have time just to give you some quotation at the end of my presentation, added to my presentation, just to illustrate this point. Or to put otherwise, there is a self and correlated expansion between the asset and liabilities side of banks' balance sheet, which is a fact widely recognized now, not only by minority heterodox such as the Minskian or Marxist researchers, but now by a significant share of the so-called mainstream economics in this field. I think of very, very interesting guy. Haldane gave a very, very significant speech on this point, saying, for instance, regarding the connection between assets and liability, saying, for instance, that in the last decade, banks have successfully broken their balance sheet chain. So it's quite interesting and meaningful proposal. Of course, Minsky, and I will come back on that in the conclusion of my presentation, explains that a bank is not a money lender as everyone is supposed to believe. It could be a surprise for you, but I don't think so, that a bank is not a money lender. I shall explain why in a moment. Or in a Marxist framework, what Marx called fictitious capital. I also will give you some refreshing quotation from Minsky and Marx at the end of my presentation. I just move on. If we start from Minsky or from Marx to understand that banks is a complex organization able to create credit and not only taking deposit institution and lending the deposit. So you have to understand, very important in my view, that even from a theoretical perspective, probably what is called the securitization, I mean the ability by bank to pass the hot potato to the market by issuing security from more or less safe loans to people or to company. You have to understand that the 30 years, the last 30 years was very, very active in the creation and the duplication and the multiplication of the so-called credit economy or fictitious capital economy, call it like you want. And in my view, it's very important, I stressed in bold letters this point, there has been a strong and economic and social irreversibility which has been created in the last 30 years, making very difficult a simple return to before, I mean to the so-called good time of the separation between investment and retail bank. And I just quote Minsky on that point, but I could draw upon a very large literature on evolutionary economics. I mean explaining that economy is not a kind of balanced economy cleared by a self-regulating market in bank or in industrial activities. Capitalism is a very evolutionary system, as Schumpeter, of course, used to say, and there are some turning points from which it is very difficult to go back. Of course, because I think that economics is a social science, I think we can go back. But I mean, we cannot go back only with classical or technical means. I mean, trying to look precisely to at what point the banks could be separated. I mean that the kind of irreversibility I mentioned are so strong as to need more what I could call radical proposal. Another issue relating to the regulation of the banking system is the technical complexity of the separation. Some commenters, especially Kane, in a 2012 paper, and he had spoken well before this paper. He has used this formula of regulatory dialectic, meaning, as I try to define, that there is a kind of dynamic interaction of the conflicting forces supporting a process of endless action and reaction. If you want, if you try, if the regulatory cat tries to catch the bad and speculative bank mouse, it is supposed that the mouse will be always able to circumvent, just to bypass the trap raised or put by the regulatory. And of course, it is a correct point in my view. We saw very many times, either in the banking system or in the industrial system as such, that each time a regulation is implemented, large holding, large business are able, or try at least, to circumvent this kind of regulation and oblige a regulatory institution, if it wants, to propose again a new regulation, but it takes years and years to be discussed because you have very law issues and lobbies and so on. So before a new regulation is implemented, time has passed and the large major corporation in industry or in bank are able to draw profit, to draw benefit from the existing regulation. So one of the concern with this kind of proposal is that, for instance, and I will come back regarding Basel II, or Basel III, sorry, is that this kind of technical proposal of separating retail and investment could stimulate innovation and, of course, increase the cost of regulatory control. So, another point of the reform proposed, it's not in exactly the Liikanen reform, I am addressing the EU reform. So the first was the separation with many difficulties, and so far not implemented at all. Not implemented at all, not before 2017 in the best case, but probably it will not be implemented at that time. Another proposal, probably you know, is to put stronger capital requirement as Basel III proposed. So the idea, I jump probably very quickly on this slide because I suppose that you are informed on that, but the basics of the Basel regulation, which began in 84, I think, or 86, I forget, is that the banks are inherently fragile institutions. On the liability side, it is because debt is much more important than their equity capital, to put otherwise they are leveraged, and on their asset side, because there is a need to weight the risk, I mean, which kind of loans are they organizing. So they have to be regulated and watched through capital restriction or leverage ratio. So the linchpin of the Basel system was to measure loss exposure by the sum of risk-weighted assets. I do not comment. I will come back in the discussion if it is needed. Still, Basel I and II were based on the idea that the market is efficient in measuring and managing its risk. Basically, the idea behind Basel I and II was the market was efficient. You can trust the bank because they were interested in more regulations. They are themselves to fight against very bad financial actors such as hedge funds at that time. Now it's called shadow banking. So you could trust the bank in the self-implementation of the Basel requirements. Of course, it was not the case, and you can see that I will come back on that. Basel II was even not fully implemented, but even if it had been implemented, it was not sufficient to prevent the financial crisis, which is firstly a bank crisis. So Basel III, now under discussion, is to raise the minimum of capital requirements in the so-called Tier 1, I do not develop, but just raise the need for banks to have more own funds, equity funds, if you want, to put into action extra buffers destined to absorb losses in period of severe financial stress, and so on and so forth. In short, you can see on the paper, on the graph, the progress in the control of the capital of the bank, the equity base of the bank, going from 2% of their assets to 7% with a distinction, but I do not comment on that, with a distinction between Tier 1, 4.5, and Tier 2, the so-called Tier 2 and Tier 3. So the critique that had already been made to Basel III, you be relaxed, it's a far way off to be implemented. But even on the paper, the main critics addressed to Basel III is that basically it takes up the same philosophy as Basel II. I mean, the measurement and management of the control of the requirement remains in the hands of the banks. Too complex regulation will be again bypassed by smart financial and legal engineering. For instance, sorry, okay, no, it's not my point. And three, that shadow banking, I forgot to give you some information on shadow banking, that is non-banks, hedge funds, private equity, and so on, are not concerned. I did not show you, because it was in the part I did not address, but if I can find it, I'm afraid I will not find. I have to say that in the last Financial Stability Board report, I mean this kind of gendarme in charge of monitoring the financial market since 2007, in the last report in December, released in December 2013, there is a significant figure showing that the shadow banking has increased since not only 2007, but in the last 2 years, I mean 2012 and 2013. And more interesting, it's my point here, I did not find the graph. The Financial Stability Board report mentions that the main reason for the increase in the so-called shadow banking, shadow means somebody you don't know very clearly, you don't know who is behind the draft and so on, shadow banking, the main reason for the rise in the shadow banking turnover are the banks themselves. So there is no doubt that the interconnection between the so-called regulated market with bank, with Basel III, with separation of banks, investment bank and retail bank, there is no doubt that the connection between the regulated bank and the shadow banking has increased in the last year. Again, it's an evident, observed and written by a very, very official institution called the Financial Stability Board. And in its last report, in the late year. For instance, you can see this kind of contradiction. I mentioned complex regulation will be passed by a smart financial institution. Invest bank, we have no deposit, will have difficulties to sell bonds to insurance, which are severely regulated in Basel III. So probably you will have a kind of trade-off and circulating turnover of assets between both, one from the regulated banks to the unregulated bank, such as investment bank, for instance. And again, just to conclude on this point, you can see that despite all the efforts made by the financial community, I don't know why I have no the end, okay? The global capital to asset ratio, I mean it is a Basel ratio basically, remained very stable, did not increase much from 4.25%. You can remember that the objective is to reach 7%, and we are only to 4.25%. And moreover, in 2012, only 21 out of 27 member states had implemented rules, the rule of Basel II. After the regulation, the separation of the bank activities, after the Basel requirement, I address now the last point, indeed, of my presentation regarding the so-called banking union. You might have heard that in 2011, the member state adopted with very, very loud cries the banking union directive, as they are called in Europe. The objective of which is on the long term of the banking union, basically I will address this point, but basically is to try to harmonize the European system, is to build a sustainable EU banking policy framework, strengthening the single market and reinforcing the unity and solidarity of the EU, for instance, breaking the doom loop of self-reinforcing deterioration of government credit ratings and banks headquartered in them. In short, the accusation behind this sentence is that rating agency and bank were complicit in the making of the financial crisis before 2007. You probably know that all the banks which collapsed or near collapsed after 2007, all the banks were very, very high ranked instead of Brazil, which has been downgraded by the Standard and Poor agency. Incidentally, just a couple of months before the World Cup, meaning, in my view, at least, it's not the only reason, of course, but it may be a reason that with the downgrading of Brazil and of some of the main Brazilian banks, lenders, creditors, or in my language, financial capital, receive more interest each time they will lend to the Brazilian government or to the Brazilian economy, and probably the Brazilian economy will need some money to lend just before the World Cup, and each downgrading of the Brazil rating is a bonanza for the financial markets, where each time they lend to the indebted Brazil. But it's my view. So, in short term, the objective of the banking union is to create mechanism of supervision and crisis resolution. I mean, it's more, here you have a very large, almost very political objective, agenda. Here you have a very short-term, almost technical means to resolve the looming crisis, because nobody doubts that the crisis is again and again simmering today. There is no doubt that a new crisis is in view in Europe or elsewhere. So putting in place, implementing some kind of mechanism of supervision and crisis resolution could be, in their view, at least in the view of the member state, a mean to prevent or to elevate the cost of the crisis. So what are the main components of the banking union directive? There are indeed 3 directives. First, to implement a new single supervisory structure. It was the easier part of the agenda, and it was agreed on in April 2013. I will discuss some problem, but it was agreed by all the member states of the Eurozone to implement a single resolution mechanism, the basic idea of which is to hold the creditors of the bank and not the taxpayer as accountable for if the bank happens to collapse or to fall apart. It will be to the creditor or to the holders, owners of the bank, and not to the taxpayer to pay the bill. And 3, implementing of course, if you have a single resolution mechanism, you have to implement a kind of financing institution. It's called the Single Bank Resolution Fund, which is, for a lot of reasons I address, a more complex issue. Basically, but I developed this point, it raised the issue of who decides that a bank has or not to be shut down. We will pay, and we recapitalize the bank if it is agreed to recapitalize. I mean, which will it be the national government of the collapsing bank, or will it be the so-called single bank resolution fund? And you will see in the next slide the difficulty. But just before addressing the difficulty of the task, you can see that the banking union so loudly proclaimed in 2013 is only to be fully implemented by 2025. Think of what does mean 11 years in the life of financial markets, for instance, and for everybody, but especially for the short-termism financial markets, of course, it's an eternity, it's a century, and it means the very, very tortuous and very, very thorny path to be borrowed if someday the banking union was to be implemented. So I do not develop this point because I wanted to be too long in my presentation. Before addressing the serious political economy issues, I just mentioned the proposal themselves. So the first proposal is to appoint the European Central Bank as the supervisor. It seems evident that it is a role of the European Central Bank. It is endowed with very strong means, capabilities, and so on, and it, to some extent, it mimics the process which took place in the U.S. when the Federal Deposit Insurance Company has been given the role of the supervisor. 2, only the large banks, the large European banks, should be regulated, or more precisely supervised by the ECB and watched, monitored. The goal being to monitor them to prevent any kind of collapse, because they are considered as very, very too big to fail banks. So, but it is only 130 banks. Of course, it's important, but you have in Europe around 50,000 banks, 5,000 banks, meaning that only the largest bank will be waged you can understand all the mess I just will address in a moment. I mean that behind this kind of understandable language, that means that the Commission is aware that it will not be able to put in place a kind of European system, but only a multi-domestic system at the European level. And again, it shows that the European level is plagued with some institutional contradiction I mentioned in my first presentation last week. So, let me address the issue raised by the European Union banking on the different points which are proposed, I mean supervisor, resolution mechanism, and then funding mechanism itself. So you have, to begin with, some technical difficulty. Will the resource collected from member state be sufficient in case of crisis? The fund is actually endowed with only, I could say, 55 billion euro, and of course, you can imagine that it's notoriously insufficient to address a possibly systemic-like bank crisis. Two, it's not really technical, but I mentioned here, it's probably wrong to put here, but it seems to be technical. Which agent will be the supervisor? So it seems to be a technical discussion. It is not, indeed. And of course, one of the issues raised that it could be a kind of conflict of interest within the European Central Bank, being on the one hand the supervisor, and two, in charge of the resolution of the crisis if a bank happens to fail. So there is a kind of risk of what is called conflict of interest. At a more political or institutional level, if you want, a very, very, very underlying weakness of the proposal and concern for the proposal of the banking union is you have again the play between the European institution as such and member states, countries. Who will decide the failure of a bank? Who will pay for failing bank? Actually, the system, as I mentioned before, is that even if the flow of money goes through the European level, it's the country, which is the domestic country, which is in charge of funding its domestic bank if it's failed. So it's kind of a circular process, as I mentioned before. And of course, as soon as you raise the issue of the role of member state, you have emerging the role of Germany. Of course, you have the role of UK on financial matters. It's very important. And I just mentioned bypassing the UK, but of course it's very important. But to focus on the main obstacle, so to speak, to a very significant banking union, you have to take into account the role of Germany. I just read in the Financial Times, just for when I polished my today presentation, this sentence I just quote, at German behest, rules for pooling banking union rescue funds are laid out in a side deal between government rather than under legislation agreed between EU member states and European Parliament. Sorry. You can see the timing, it's just 2 weeks ago, hardly two weeks. So it means that it's a very long way off to go on the way of the banking union. And why Germany is so reluctant to pooling the funding and more generally to pooling the policy and sharing the risk with other member states regarding the risk raised by financial market for a lot of reasons. I just mentioned two of them. First, Germany does not want to be involved in German money taxpayer for rescuing banks in other countries. Very well known claim by Merkel that we have not to pay for the Greek or for the Portuguese and so on. And also another reason, because the German banking system has been very, very strongly hurt by the crisis. It was not a system crisis immune. It was very, very deeply hurt, but it was rescued by the German government. Almost, the estimate are that almost 9% of the GDP was allocated by the German government to rescuing the German system. So do not think that the German system would be very brilliant and prospering and so on and so forth. But another reason is rather that a significant portion of share of the German banking system consists of local institutions, cooperative banks, etc., which are regulated with very, very different rules, and of course, again, an evidence of the persisting role of nation, state, country, territories, boundaries, whichever you want, while people are keen to speak of globalization or a flat world and so on, the German government is very keen to protect this kind of organization, not only for the defense of capitalism, of capitalist banks, but also because some of these banks are closely rooted in the social communities and perform to some extent some kind of social useful function. So it's not only for negative reasons that the German government is very, very cautious and dismiss and refuse any kind of pooling or funding at the European level, but also for good, I could call them so good reason. I mean, you have social banks, community banks, which are in relation with the needs of the communities, and of course, they want not to be involved in a very, very merry-go-round of the financial markets. I just mentioned bypassing, but I should more explicit, of course, that the UK, which is not member of the Eurozone, remember that, is also very cautious of with the implementation of the banking union, and you have to have in mind that if Germany 12% of the GDP is accounted by the automotive industry, I mean, Germany remains a very strong manufacturing country. In the UK, it's the other way around. 12% of the GDP is realized by the financial service, as they call it. So the banking union, if we jump at a more political economy level, raise some issues. The first issue, of course, is that it seems like in the separation of bank and between investment and retail bank, that the bank business seems to be very favored by this kind of banking union. I mean, according to a NGO, very interesting NGO, Corporate European Observatory report, indeed, when you read at the pages regarding supervision, rule will be very lax. From a political economy perspective, the banking union is one of the objectives by financial capital for uniting the European market. I mean, German bank, French bank, UK banks want to be protected from competitors, but they are also keen to buy up, to acquire other banks in Europe. So, of course, they are not living in an ideal world in which Europe is a leveling playing field, but of course, each step put forward in the direction of unification of Europe is beneficial rather to the large than to the less larger banks. So the completion of a financial single market is a long-awaited view and objective by finance capital in Europe and even overseas by the UK. Strong obstacle will be put to the possibility for member states to implement higher than Basel III standards. I mean, it is required that if they want to implement more stringent rules than Basel III, they will have, member states will have to ask for authorization. The universal model, as I said, has not been abolished, meaning that in the world, again, of Andrew Aldan, a very high top ranking at the Bank of England, I remind you, so as a beast being tamed, responds no. You can see that the result, the outcome, I just finished in a couple of minutes. You can see that evidencing what I say, I mean that all the reforms announced or already implemented in Europe are not very, very hard with the European banking system. You can see on this slide excerpt from the last European Central Bank report each semester. This one was released in the midst or in September 2013. You can see that the Erfindal index, as it is called, the top 5 banks have been gaining more and more share of the European market. This kind of trend reflects the stronger concentration by the top 5 European banks. And you can see, at the end of the day, find the graph I wanted to show you, that the unregulated activity, the so-called shadow banking, has been dramatically increasing in the recent years. And again, it is explained that it is in relation with banks. So, I think that I have to conclude. I will come back on this many points, but I just very briefly summarize the final point of my presentation, just to make stronger the point that the political economy of the regulation of the EU banking is not mainly in favor of the population and rather in favor, or at least very modest, with the EU banks. You can see a very, very harsh saying by Krugman in the New York Times, saying that the so-called regulator in charge of regulating and refraining and reining in the American banking system, financial system in general, had transformed from watchdog. Watchdog is a word used to name a regulator. Had transformed into a laptop. A laptop is a small and very mild and soft dog you can put on your lap. On your lap, and we can slick your arms and so on. From watchdog to lapdog seems a very good formula in my view. So expectations where high, results are still modest. First, because of the strong resistance of the bank, and this call for the role of bank in economy. What are their role? And just to conclude, just to refresh our minds and give a more theoretical turn to my presentation, I just leave you reading some excerpt of what Minsky said about what bank is about. Banking is not money lending. Of course, everybody knows that the role of bank is to lend. To lend, a money lender must have money. When a banker vouches for creditworthiness or authorizes the drawing of checks, he needs to have uncommitted funds on hand. And just after he says that it would be foolish, the banker would have some money, not lended, and so on. And another significant sentence relevant to our discussion, I hope so for our discussion, is that because banks operate the ultimate payments mechanism, those liabilities of banks which serve as a medium of exchange, I mean as taking deposit and allowing people just to buy and sell goods and not speculate, it's what Minsky means by the medium of exchange, also serve as a standard with which domestic public and private debt are denominated. For this reason, their value cannot be compromised by market events. It is an excerpt of the very late writing by Minsky in 1995 when he proposed a reform of the regulation of the US banking. It's a quite interesting proposal which has been just refreshed by in a Jan Kregel presentation. And finally, let me refresh our and your minds with Marx, which is of course different of what Minsky said, but you can find some kind of similarity. And of course, it's a very challenging issue to compare what they said and to discuss this point. Marx said very various parts. This one is excerpt from what is called in English notebooks, and in German the Grundrisse, the preliminary notes, if you want, to capital. The power which each individual exercises over the activity of others or over social wealth exists in him as the owner of exchange value of money. In my view, it goes well beyond this very repeated capitalism is a monetary economy of production. You have here more than that. The social wealth is money. The individual carries his social power as well as his bond with society in his pocket. Of course, you have to take into account that for Marx, money is not only a medium of exchange, as aptly Minsky said. Capital is by definition money, and the greater portion of this money capital is purely fictitious. All the deposits, with the exception of the reserve fund, are merely claims of the banker, which, however, never exist as deposit. You have very strong similarity with what Minsky explained 1 century after. You can just, for the fun, compare to what of the most famous advisor to Clinton or to Bush, I do not remember, and one of the most read handbook by students in economics, what is called the advanced economics, begin at the very beginning of his books on macroeconomics by saying, page 3, that incorporating money in models of growth would only obscure the analysis. Muito obrigado. I sit here because of the wind.
Maybe our life a bit easier. Okay, so it's a possibility. No, but I think I have some comments. So, if I understood your presentation and your main points, you give us, let's say, two levels of problems, and one is related to the special characteristics of the European Union, and you are, let's say, very critical of the European Union in a deep sense. Maybe we could say that we don't have this integration, so I think that you have mentioned a kind of multi-domestic system and not a union at this sense, and maybe at this moment with the crisis and such important kind of political negotiations, this became much more evident for us, because in a certain sense we could think that, oh, it's a wonderful project, but it has such a strange macroeconomic framework, so why did they do that? But as time goes by, it seems that we have, as we have said, a conservative project, and that it is not an integration and a political economy perspective. So it brings to this banking regulation another, let's say, level of difficulties, of complexities. And trying to separate that, if it is possible, the banking regulation itself, and I think that we could say, let's say, kind of inspired by the end of your presentation, that we have the problem of the regulation of capital in itself, because that's the point. It's not a problem of regulation of the banking sector, because it is completely connected with the so-called shadow banking. So we are dealing with the problem of regulation of capital, and that's why this is so important. So we have this level of, let's say, technical complexity, how we're going to try to separate different activities that are completely connected with this kind of variations of Volcker rules and Vicker rules, let's say US model vis-a-vis the UK model, and let's say try to measure until this point we can have this, let's say, size of banks, and more than that it's not possible anymore. So we have this kind of, let's say, technical complexity, and added to a very, very strong political complexity, and in this perspective connected to this, let's say, regional and very important connections at the level of the European Union. So we had the opportunity to talk before, and I told you, let's say, my concern or my anxiety, in the sense that it seems that there is no alternative. Cannot be the only alternative. So I would like to express that again, kind of sharing this with the colleagues and students that are here as well. Yes.
Okay. No, first I have to say that in order to go to my point, I have been sometimes too much strict in my presentation. I mean, just to reverse the conventional wisdom on the fact that the European Union is gaining more and more positive integration and so on, probably I go in the other direction too much in excess, of course. I mean, there is a real problem for Europe, for the banks, for capitalism in general in Europe. That is, there is a crisis. So it's not only words and discussion on words that the member states, the Commission have. It's really a substantial discussion. How to save a collapsing system. In my view, the view of Minsky to some extent and Marx, of course, it is a system which can be preserved on social basis. I mean, it's not a technical issue. You can print whichever money you want to save the banks. The problem for the member state is to socially save the banks. I mean, to make them legitimate, to make them able to go on making their activity and so on. So there is a kind of trade-off in the discussion today. There is a real substantial discussion. I would not give the impression that all what I said is only a smoke screen behind which capitalism, banks are drawing the ropes of the puppets of the member state. It would be really a counter in the other way I want to go. My point, rather, is to say that member states are confronted with trying to rescue a system which, in my view, but also the evidence, is unsustainable. That is, it is the $100 or euro question. I mean, they are really discussing each day how we can save such bank if this bank has landed to Portugal, and that in 1 month, because of a minor strike or a civil servant strike or for whichever other reason, because Standard & Poor downgrade Portugal and the interest payment has become unsustainable for Portugal, for whichever reason, what and how we will save this bank, French, German, British or Netherlands, which if it has landed to the Portugal government. It's a real question. It's not a smoke screen. What is difficult is, of course, to try to save such a bank while keeping the same unsustainable framework. I mean, a system in which, you know very well that in the so-called lost decade in Brazil, the more you ask austerity to people, the more you are refraining public spending, and the most the recession goes ahead, and the most the share of interest as a proportion of the GDP of the public budget is rising. So it is the catch-22, as the English say, problem. So I say what I say because there is step forward. I mean, the attempt by Liikanen to separate is a very good and heroic proposal. And in France, we have roughly the same kind of proposal as the Liikanen report. But in the hearing of the French National Assembly, it was 1 year ago, around, the French head of BNP Paribas told to the French deputy who proposed the law separating bank between investment and retail, that BNP Paribas would be concerned with only 2 or 3% of its turnover. So it was a very tiny proposal. So I think that you have here the challenge, the daunting challenge for regulator, for government, for population as well. So much awaited reform as a separation of investment and retail ends up with eating only 2 or 3% of the BNP Paribas turnover. It's incredible. And you can see the effort and the time spent and the cost spent and so on for at least 3 years. So it is my view on that point. You have real move forward or attempt to move forward, or sometimes move forward, but this move ahead remain constrained against a very, very constraining framework of an unsustainable, unregulated bank, shadow banking, and so on and so forth. So it is one part of my general response or comment, not a response. And I mean that from my view, of course, it means that if you spend so much time to get a Glass-Steagall Act like reform to just hurt 2 or 3% of a very large European bank, it's very, very difficult to imagine you can move ahead with no social forces with you. I mean, it's not only a political discourse I hold. I think it's discourse from an economics perspective. When Greece collapsed, of course, immediately the French government asked for a European plan to save Greece for a very, very good reason. It is that the bulk of the Greek public debt was held at that time. Now they're just past the hot potatoes, but at that time, the bulk of the public debt was held by French banks. So you have a kind of circular flow in which government, including the French, but also other government, European government, supported or claimed to support the Greek government. Indeed, they support, at the end of the day, their domestic banks. The same process has been taking place for Ireland, the Irish country. A network of critical NGO, including Attack Europe, published very, very comprehensive figures, unchallenged figures, showing that Ireland has been helped by the European Union, by the European member state, but Irish banks, indeed, Irish affiliate of UK and to some extent American banks, received the bulk of the public support given by member state, European member state, to the Irish government. So, confronted with this kind of situation, the proposal of giving back the European banks to the community, to the people, and no other word as nationalization has been invented to define this kind of process, has been proposed. I mean, it was a technical proposal to propose nationalization of banks, because if you don't nationalize bank, you cannot separate, for instance, investment from retail activities within bank, because of course the part of the bank which will be regulated will transfer. We see that every day with the fiscal paradise will transfer its speculative activities to foreign affiliates of the same bank. Foreign affiliates in a country which are not regulated by the same regulation. So nationalization, if we can explain on a technical base, not only in an ideological base, is critically needed, in my view. It's a minority position in Europe, of course. I am just defending a position, just to explain in relation with what you said, that we cannot end up with a crisis only with technical reform. And in my view, the European member states try to save the system with technical reforms.
Claude, I've arrived too late to, I've lost the most part of your interesting presentation, but I'm impressed by this quotation that you used of Marx, because Marx has stressed a point that is very important, that is that money, or trying to individualize the owners of wealth, are responsible for the direction government of our forms of society. Yes, and I remember another quotation of Claude, surely probably suggested by Marx also, when he said that power is in economic and social terms is very important, and it's very great. It's very interesting for the owner of power. And nothing serves better the power than theology that tries to hide its exercise. And when you put this passage of Homer's, when he's trying to say that money would only obscure the analysis, isn't it this a symptom of this conception that try to put politics outside the domain of economics? Try to, okay, have you understood?
Yeah. Sure.
Because it's important, this, because in the most part of economic profession, the most part of our economic courses, disciplines, the domain of politics is completely ignored. Yes.
No, I am sure that Romer is claiming that it's better to rule out money from the models because probably he thinks that it's a political issue. No, I can only agree with you. The discipline, you know better than me, the discipline was created as a political economy. I mean, in which the relation of power between people were and are quite critical. And of course, we know, as an historian of economic thought, that increasingly power was expelled, market was said to be the power, and then market, once they said to be the power, began to be said self-regulating power, and so on. So there is no doubt that that people like Galbraith has become absolutely out of fashion in the US in the late 70s. There has been a quite interesting research by a French and a Canadian sociologist on the sociology of the economists who take the power in the late 70s in the US. That means at the international level. And these two sociologists, Bourdieu inspired by the school of Pierre Bourdieu, showed that at the end of the 70s, in relation with the deep economic crisis which took shape at that time, of course, people like Galbraith, Dillard, the Keynesian, and many others, I do not give their name, became out of fashion. And how this kind of new generation of economists at Chicago, at the University of Chicago, of course, try to replace the good old political economy à la Galbraith and so on, by a very, very disincarnated mathematical economics in which you have not to be concerned and troubled with power. It's very difficult to put power in econometric models. As I said, another French economist, the attempt to include power in the economic game was realized by the game theory. Game theory is an attempt to put agents in relation, and negotiating, and sometimes bargaining, and sometimes lobbying, and sometimes having power with each other. And as said this very clever economist called Bernard Guérien, it was a real considerable progress for the mainstream economics to include two agents in the game theory, because during 1 century, the mainstream economics have only one representative agent. It was a neoclassical one representative agent. And 1 century after, the mainstream economics realized the prowess of making appear a second actor. So it is a kind of power relation which is now learned, taught in university. No, I think that the point made by Marx probably more than by Minsky. Minsky, everybody knows that Minsky carefully read Marx, was Marxist in the early 50s, but it was at the time very difficult to be Marxist in the US, he said himself. I quote some people having discussed with him, and it is in one of the books on the Minsky life, and Minsky preferred just to be more focused on monetary and financial issues. But I think that the point, and thank you to underline this point, the point made by Marx is that economics is all about power relation at the end of the day. Marx has been always narrowed down to an economist and criticized for economists over-determining the politics and so on and so forth. I think it's a very, very dogmatic Marxist which realized that. I think that for Marx, economic relation were and are power relation. And the fact that everybody holds social power in his pocket, in my view, very, very significant. Of course, everybody has not the same quantity of money in his or in her pocket, one, and two, money is not only a medium of payment, it's not only a means of payment. Some people hold money in their pocket, but they use money as capital. My second different quotation. So, of course, in my view, I will make again very likely this point on my conference on transnational cooperation. I think, for instance, but I just make the point here just to explain what I think, that now in large transnational cooperation, I mean industrial transnational cooperation, what is really entrepreneurial profit, realized on a classical base of a Schumpeterian entrepreneur, and what is rent extracted thanks to power relation, to the edge gained by large transnational corporation over smaller corporation and so on, the boundary between entrepreneurial profit and rents as gained by a market power, the boundary is increasingly blurring. And in my view, it's just a point made to reinforce my argument that many things in economics and economy, sorry, are about power relations.
Seems that we are ready. No more questions. So I'd like to thank you again very much for your very comprehensive and detailed presentation, and for being here with us. It's a pleasure to have you here, and thank you.
Okay, it's a pleasure to meet you.